Hi, and welcome to the only line that matters, the moving average 200. After years of navigating these live markets, if you force me to strip away every indicator, every complex algorithm, and every oscillator from my charts and left me with just one single line to trade with for the rest of my career, it would be this one. Welcome back to the channel. When you first start trading, you're told to look for the holy grail. You overload your screens with MACD, RSI, and Bollinger Bands and complex multi-layered patterns until your charts look less like a trading setup and more like a Jackson Pollock painting. But professional trading isn't about adding noise, it's about absolute clarity. Today, we're breaking down the granddaddy of all the technical indicators, the 200 period moving average. We're diving into the fascinating history of this line, why legendary billionaire traders refuse to trade without it, the psychological mathematical reason it's set to exactly 200, and exactly how you can set it up on TradingView today to instantly filter out bad trades. Let's get straight into it. So, the history of this line. The pre-computer era. To truly understand why this indicator holds so much power today, we have to look back at how it started. Long before high-frequency algorithmic servers and charting software existed, trading was done by hand. In the early to mid-20th century, legendary technical analysts and tape readers had to plot every single daily closing price using graph paper and a pencil. If you wanted to see the broad direction of a stock or commodity, you had to calculate its moving average manually. Think about the sheer manual labour involved. You had to add up the last 200 days of closing prices, divide by 200, plot that point on the page, and then do it all over again the next day, dropping the oldest date and adding the newest. Because of the time and effort required, traders didn't choose arbitrary numbers. They looked for a baseline that represented a true macroeconomic shift. Because it was so heavily relied upon by the pioneering cartographers of Wall Street, it became institutionalized. It was the literal dividing line between an asset that was technically healthy and one that was structurally broken. When computers finally arrived in the late 70s and 80s, the 200 moving average didn't disappear. It was hard-coded into the foundation of institutional finance. Why the 200? The maths and the myth. A question I get asked is, why is it 200? Why not 150 or 250? The answer comes down to the rhythm of the modern market calendar. There are roughly 252 trading days in a single calendar year when you subtract weekends and market holidays. If you look at 200 trading days, it represents roughly 10 calendar months of market data, or roughly 40 weeks of live trading activity. This specific time frame strip mines all the short-term market noise, the daily algorithmic whipsaws, and the temporary news-driven panic out of the equation. It gives you a clean look at the structural, high-horizon macroeconomic trend. But there's an even deeper psychological reason it works so well today, and it's called the self-fulfilling prophecy. Because every major central bank, commercial institution, sovereign wealth fund, and legacy hedge fund manager uses the 200 moving average as their macro trend filter, millions of buy and sell orders are clustered right around this line. It acts as a massive psychological floor or ceiling for global order flow. When price approaches the 200 moving average on a higher time frame, the entire smart money world is watching the exact same level. Why? Who are the market legends who live by this indicator? So, as Paul Tudor Jones is quoted as saying, "My metric for everything I look at is the 200-day moving average of closing prices. The whole trick in investing is, how do I keep from losing everything?" But you don't just have to take my word for it. The absolute goats, the godfathers of all time of macro trading, have built their entire defensive risk frameworks around this single indicator. Paul Jones was a billionaire hedge fund manager, and he famously predicted and shorted the 1987 Black Monday market crash, tripling his fund's value in a single month. In his masterclass interviews, he explicitly stated that the 200-day moving average was his number one defensive tactic. He said, "If an asset is below the 200-day moving average, you play defense, you get out, or you look to short. You never buy a falling knife." Then you have Marty Schwartz, the legendary champion pit trader and author of Pitbull. He famously wrote, "I always check the 200-day moving average before entering a trade. If price is below it, I won't even think about buying." When elite traders who have survived multiple decades in the market tell you that nothing good happens the other side of the 200 moving average, it pays to listen. It's not just a trend line, it's a structural shield for your trading capital. So let's jump into the screen right now so I can show you exactly how to set up this correctly in TradingView without cluttering your workspace. Up here, on the top panel, you click Indicators. You search for SMA or moving average or simple moving average. Mine's favorited with a star. I use it all the time. You just click on it once and it'll add it to your active chart. Now, by default, as you can see up here, TradingView usually inputs a short-term length like 9 periods. We need to modify this, so you hover over the indicator title, click the gear icon and open up the settings like this. Under the Inputs tab, you look for the length and change that value from 9 to 200. Next, head over to the Style tab. Because this is our anchor line, we want it to stand out clearly from our day-to-day candlesticks. I prefer to change the line colour to a high visibility blue, but you can choose what suits you. Crucially, come down to the thickness setting here and turn it up a notch or two. What we want to see is this major structural bad boy frontier immediately, even when we're scanning across multiple asset classes or timeframes. Click OK and your chart's primed. There we go. Now that you have it on your screen, let's talk about how to actually use it as part of a disciplined trading system. So after years in the game, I boil its use down to 2 core rules of engagement. Rule number 1, it is your ultimate macro filter. If the price is trading cleanly above the 200 moving average on your primary execution time frame, the long-term institutional momentum is bullish. Sorry, I just put an arrow. So if it's above, it's bullish. If it's in my system, that means I'm strictly looking for buy setups. I'll not attempt to counter trend short a market that has institutional support behind it. Conversely, if price is tracking below the line, the market is structurally weak and I am prioritising short setups and protecting my capital in cash. Rule number 2, it is your defensive anchor. The 200 moving average keeps you out of catastrophic market distributions. It means you never get caught holding a position that is melting down to zero. As we all know, trading isn't about being right 100% of the time. It's about managing your risk with absolute discipline and keeping your losses small when you're wrong. The 200 moving average gives you a definitive, objective line in the sand. Pull up your charts today, drop the 200 moving average onto your favourite assets and look at how beautifully the market respects this institutional floor. And if you found value in today's video, make sure to hit that subscribe button, smash the like button for me, and let me know down in the comments, do you prefer the simple moving average or the exponential variation of your macro trend for your macro trend tracking? Trade safely, protect your capital, and I'll see you right here for the next session on Trade with M today. And as my mentor says, I wish you happy trading.